Our next guest is Greg Dickerson. It took me forever to get this gentleman on our podcast. It is a perfect time to have him on. He is a statistician, genius, brilliant man, looks at everything from a very different lens and gives you a really great perspective. It's an awesome interview. There's one word I love more than million, and it's billion. And Greg's current clients have over 2 billion in assets under management and deals in process. This is somebody you want to take some advice from. It's an honor to have someone like him on our program. So Greg is a serial entrepreneur, real estate developer, coach, and mentor. He has bought, developed, and sold over 250 million in real estate, built and renovated hundreds of custom homes and commercial buildings, developed residential and mixed-use subdivisions, and started 12 different companies from the ground up. Greg currently coaches and mentors some of the top entrepreneurs, real estate investors, and real estate developers around the world, helping them start, grow, and scale their business, raise more capital, and do bigger deals. Greg's current clients have over 2 billion in assets under management and deals in process. Greg is an expert on the topics of entrepreneurship, leadership, and real estate, and is regularly interviewed on some of the top real estate investing and business podcasts today. Greg served in the United States Navy right out of high school and has always been a leader in the community, as well as supporting, advising, and serving on the boards of several churches, ministries, and nonprofit organizations. First, Greg, thank you so much for your service and also being a just well-rounded, amazing human being to the community. I look up to people like Greg, and I take a lot of time to have the best guests on this program. And if you look at some of the past interviews and some of the folks that we've recently had, I am trying to find the best guests that can really give us knowledge that we can apply to what is happening in today's market. I think these are very relevant interviews. Greg talks about the rising interest rates, what's going to happen. I ask for his crystal ball, what we can expect for the future. And it's great. So I love you guys. Thank you for following. Truly an honor. Appreciate it. rei.mba. Check out our roadmap and some of our other information. Hope you enjoy the interview. Cheers. All right, guys, you heard the great intro. We have Greg Dickerson here. Greg, thanks for being here.
Hey, thanks for having me. Pleasure to be here.
For sure. Rather than waiting a minute, let's get right into the heavy stuff. You're a very knowledgeable guy. You've made it through some crazy cycles and you have some amazing transferable skills. First, thank you for your service.
Yeah, thank you.
Thanks for keeping us free, able to invest in real estate. And right now, people are just kind of going nuts with things. If we could just kind of talk about today and some of the things you've historically learned to deal with times like now.
Yeah. So very interesting times. A lot of people that are in the game now weren't around in 2008 and 9. And I was a real estate developer, hot and heavy in 2008 and 9, early mid career. I started my journey in 1997. So, I was about halfway through my building cycle then, had $40 million worth of development loans that I just finished on some product and was working the permanent financing on the back end. And the banks they weren't there. I had all these permanent commitments, year, 18 months prior to starting all these projects, finished them out, went to get the permanent financing, and, nobody was answering the phone on the other end. So that was a very interesting time. And, I didn't understand the banks and how they were doing things in terms of the, credit default, or not credit default swaps, but the MBOs and CDOs and all these different things, mortgage-backed securities and, the commercial derivatives and all the things that were going on, the way they were carving properties up, packaging them and selling them. So I didn't really understand how the banks work and what was going on, but it was really interesting. I had all of those projects that were being completed. Then the market started changing. Interest rates started going up, which, I kind of knew 04, 05 was the peak of the market. And then things that started coming back in 08, 09 just caught everybody by surprise in terms of, the real estate market. But what was really interesting during that time was what the banks did and how they handled things. And they weren't cooperative at all. Banks weren't willing to work stuff out. They didn't want to cooperate. They were just trying to get properties in and get them off their books. And what we all didn't know was going on behind the scenes was you had the government, bailing everybody out, making those deals behind the scenes, making all of these lenders whole. And then of course the derivatives and the mortgage-backed securities and all those things, commercials, CMBS, all that stuff, very complicated structures and difficult to unwind in a situation like we were facing. So, like I said, a lot of people have never been through something like this and, don't really understand what's in front of us and where things can go, even though this time is very different than last time. The banks learned big lessons, very different real estate market right now in residential, but commercial, it's going to be really interesting to see how the commercial market reacts and how things are affected. The banks are much healthier, but banks are also pulling out on certain markets. I think it was Bank of America that let out a report the other day. They're not lending on office or commercial anymore right now.
Is that nationally?
Yeah, they're pulling out of that. So they're not funding development or acquisition in for office or for retail, and it's kind of broad right now because they're kind of seeing the writings on the wall in those sectors, and with the worries of recession and things like that, with interest rates going up like they are. I mean, the Fed yesterday came out. I don't know when this is going to air, but the 21st, is when the Fed had their decision and raised 75 basis points. But what they said was, we're going to go higher than you think, longer than you think, and we're not going back to zero ever. What the Fed says, we're going to keep 1% above inflation. So what the Fed told you yesterday, and the reason the markets are reacting like they are, and the reason bonds yields are going up and rates are going up, is because the Fed said we're going to be 100 basis points above inflation. So most of us know inflation is not going to come down to 4 or 5% for probably a year or two. That means the Fed funds rate is going to be 5-6%.
Whoa.
We targeted 4.5%, this year. They said, into the end of 2024, but they basically said we're not ever going back to zero.
Scary.
It is. And so what that's doing and what the bond market's doing is putting severe pressure on the commercial credit market. So you're going to see credit tightening in commercial, conduit loans, bridge debt, Freddie and Fannie. You're going to see debt, continue to tighten. You're going to see, lower LTVs, LTCs. You're going to see more reserve requirements. You're going to see more stringent underwriting on assets in certain markets. So they're going to start looking at markets now a lot closer. They're going to start looking at assets in those markets a lot closer, and they're going to really start digging into the sponsor. So things are going to get difficult. And the reason is because now investors that were funding, MBS and CMBS and those things are looking at treasuries at 4 and 5%, risk-free trade. So a lot of capital is going to go into those assets versus going into the real estate market. And with recession fears and with the things that the Federal Reserve came out and said yesterday, it's putting a lot of caution in front of a lot of the banks, a lot of the lenders, life companies, sovereign wealth funds, debt funds, that would typically fund commercial real estate. So very interesting times ahead of us. As you know, markets changing, cap rates are adjusting, and things are getting a little bit more difficult.
Yeah, everything you just said. I got, we need the transcript. That's perfect on how it's going. But there's always some, what do they say about in chaos, there are ladders. And, there's ways that people like you know how to maneuver, right? To get around that. And your expertise, I guess, in now why banks are the way they are. How do you tell someone who's thinking about getting into real estate that, you can still do it? Or is it just a bad time? What do you say?
Yeah. So number one, you got to be an expert. You need to educate yourself, understand every market's different. Real estate's hyper local. Every market's different at the state, city, area of that city, street, position on that street, and then by asset type in those specific areas. So there's a lot of nuances to real estate. Markets will adjust. Sometimes real estate, residential is a lot slower to adjust than commercial. Commercial can and will adjust a lot faster. So you just need to be in tune with what's going on. You need to understand what drives a deal in real estate, what drives value, the debt and the cost of that debt, right? Capital and the cost of that capital. So equity capital and then debt. Those are the two things that create and drive real estate deals and also the outcome of those deals. So the way we've been able to push the last couple of years in a bull market that we've been in all assets, whatever you buy today is worth more tomorrow. Now you got to lead the market down the other way. And whatever you sold yesterday, you got to buy for less today. And you got to work and lead the market down as the market continues to adjust. You need to be very conservative in your underwriting. You need to be very conservative in your assumptions. You need to assume whatever you're buying now is going to be worth less potentially for a little while. Markets are cyclical, peaks and valleys. So, once the dust settles and we get through these times and we get geopolitical issues resolved, we get banking issues resolved, we get, the Fed resolved and what they're doing, then we can be back off to the races again. But they said we're never going to be back to where we were. So what you need to understand and what the Fed said yesterday, again, they don't have a whole lot of credibility right now because they've been very weak on inflation and they've been very wrong in their predictions. But what they said yesterday was we're never going back to where we were. So a lot of people, all they know is the last few years, but the last 10 years where we had record low interest rates that we've never seen before 2008, right? I mean, what was the lowest we saw back then? Like 4%, four and a half. So where we are now is like really good in terms of general
historically.
And what inflated these values over the last number of years was zero interest rates. And that's what a lot of people don't understand in this market right now, that, there was no other yield for investors. And that's what investors are after. I'm talking about life companies, sovereign wealth funds, debt funds, hedge funds that are funding CMBS, MBS, and, Freddie and Fannie, or Fannie and Freddie. I keep saying Franny. I got a good friend whose wife's name is Franny.
I was going to say Fran Drescher.
Yeah. So, that capital's been chasing yield, and there was no yield anywhere else except risk assets. So that's why risk assets, crypto, stock market, real estate, boom, all through the roof. Now you can get yield in the treasury markets, you can get yield in the bond markets. So, that's where a lot of that capital is going to be going right now, which is going to make it more expensive, for commercial debt and more restrictive, for that commercial debt. So, very interesting. But that's where the opportunities are created.
Right.
So there'll be opportunities, educate yourself, understand what you can do, where banks are, and what they're willing to do. You can take deals over just assuming the debt. You might be able to, take deals over by providing a little bit of capital. You might be able to take deals over just using your balance sheet, outright cash deals when, banks towards the end of this year, if they've got some distressed debt, they're going to be looking to unload it. If they've got assets that they are in default, they're going to want to unload them before the end of the year so they can reset going into the next year. So there's going to be a lot of deals coming through this year, but I think the big opportunity is going to be next year once we really start to see where the economy is going and the effects of what the Fed's doing. Potential slowdown in the economy as we get into 2024. That's where you might see some real opportunities, but there's opportunities in every environment. You just got to make sure that you price them differently. You understand the values that we saw over the last couple of years, we may never get back to again. So these cap rates that we saw, we may never get back to those again. When you're measuring that against risk-free assets, and, your buy signal's the Fed. So once the Fed stops and once inflation is down and the all clear signal's been given, then, we can start putting in a bottom, and then eventually they might start reducing, but they're only going to reduce to a certain level. So you just need to understand what they're saying at the time, where that is, and then price based on that so that you're, not putting yourself out there in terms of thinking we're just going to have this exponential boom again, because they're saying they're not going to do that. The other thing that was interesting that they said yesterday was that they're not selling MBS yet. So that was really interesting. They're guarding the real estate market. They know what will happen if they start rolling MBS off the balance sheet. That would destroy the real estate market. So it's good to know that they want to see correction, but they don't want to destroy it completely.